A Vermont janitor died with $8 million in his bank account. No inheritance, no lucky break, no financial degree. Just a man who understood 3 simple things and acted on them for decades. By the end of this video, you'll understand those same 3 things: stocks, bonds, and ETFs. What they actually are, when each one makes sense, and exactly how to get started today. And the third one, it's literally what Warren Buffett said he wants done with his own money after he dies. Stick around for that. All right, let's get into it. Here's a number that should bother you. 67% of Americans don't invest at all. Not because they can't. According to a 2023 Gallup poll, the number one reason people give is, I don't know enough about it. Not lack of money, lack of understanding. And that gap, that knowledge gap, is measurable in dollars. Hundreds of thousands of them over a lifetime. So let's fix that, starting with stocks. When you buy a share of Apple, you literally own a piece of Apple. Not a certificate, not a promise, a fractional slice of the actual company. Its factories, its patents, its future profits. If Apple has 15.4 billion shares outstanding and you own 10, you own 10 real pieces of a real business. That's what a stock is. Ownership. Ownership comes with volatility. In any given year, the stock market drops an average of 14% at some point, yet still finishes positive about 75% of the time. Every crash in history, the dot-com collapse, the 2008 financial crisis, the COVID crash, the market recovered. Every single time. Made new highs, then kept going. That's why Ronald Reagan's story hit so hard. He was a gas station attendant and janitor in Vermont. He drove a used car. He held his coat together with safety pins. When he died in 2014 at 92, his estate was worth $8 million. He left $4.8 million to a local hospital and $1.2 million to his town library. His stepdaughter, Pamela Robar, told reporters, "We never had any idea he had this kind of money." No secret formula. He bought stocks in companies he understood, held them for decades, and never panicked. That's it. A 25-year-old doing that today, putting just $300 a month into the stock market, ends up with roughly $1.97 million by age 65. Wait until 35 to start? That same habit yields $678,000, less than half, for only 10 fewer years. The cost of waiting isn't zero, it's $1 million. The one action to take from this? Open a free brokerage account. Fidelity, Schwab, or Vanguard all have no minimums, and buy your first fractional share this week. Even $5 counts. You're not gambling, you're becoming an owner. Now here's where it gets a little more interesting. Bonds. If a stock is ownership, a bond is a loan. You lend money to a government or a corporation. They pay you interest on a schedule called the coupon and return your principal at the end. U.S. Treasury bonds are backed by the full faith of the federal government. They're considered the safest investment on earth. Historically, they've returned around 4 to 5% annually, lower than stocks, but smoother. Here's the part most people get wrong about bonds. It genuinely surprises people when they hear it. When interest rates go up, existing bond prices go down. Think about why. If you're holding a bond that pays 2% and new bonds suddenly pay 5%, your bond is worth less. Nobody pays full price for it. It loses value on paper, even though it still pays you. This is the bond rate inverse relationship, and it destroyed portfolios in 2022. The Federal Reserve raised rates from effectively 0 to over 5% in just 14 months, the fastest rate hiking cycle in 40 years. The Bloomberg U.S. Aggregate Bond Index fell 13% that year. 30-year Treasury bonds lost 30 to 40% of their value. People who thought bonds meant safety watched their safe accounts drop hard. Even Warren Buffett warned about this back in 2011. Bonds should come with a warning label. So when do bonds make sense? It comes down to time. Money you need in the next 2 years shouldn't be in stocks. Too much volatility. Bonds or even cash work better there. Money you won't touch for 5 or more years? Stocks and growth assets. That one framework eliminates most of the big mistakes people make. If you're finding this useful, hit subscribe. I drop videos like this every week. And the best part is coming up right now. Okay, remember how I said the third one is what Buffett once done with his own money? Here it is. ETFs. Exchange Traded Funds. Instead of buying one stock, you're buying a basket of stocks, hundreds or thousands of them, that trades on the market like a single share. The most famous is VOO, the Vanguard S&P 500 ETF. One purchase and you own a slice of 500 of the largest American companies simultaneously. Amazon, Microsoft, Apple, Berkshire Hathaway, all of it in one ticker. Here's why this matters more than most people realize. 92% of actively managed large cap funds underperform the S&P 500 over a 15-year period, according to the S&P SPIVA report from 2023. Not 50%, not 60, 92. And those managers charge you for the privilege of losing to the index. The average actively managed fund takes 1 to 1.5% annually. VOO charges 0.03%, 0.03%. That difference sounds small. It is not small. Invest $100,000 for 30 years at a 10% annual return. With a 1% fee, you end up with about $1.49 million. With a 0.03% fee, you end up with $1.72 million. The difference is $230,000. That's not the returns. That's just the fee drag. In 2007, Warren Buffett made a public $1 million bet. He said a simple S&P 500 index fund would be the hand-picked collection of the best hedge funds over 10 years. A fund manager named Ted Size took that bet. Harvard MBAs, sophisticated algorithms, Wall Street resources. Over the decade, the index fund returned 125.8%. The hedge funds averaged 36.3%. Size conceded in 2017 before the deadline was even up. Buffett donated $2.2 million to charity. Then, in his letter to Berkshire Hathaway shareholders, Buffett described what he wants for his own wife's inheritance when he's gone. 10% in short-term government bonds, 90% in a very low-cost S&P 500 index fund. He named Vanguard specifically. The most celebrated investor in history looked at every option available and chose the boring, cheap, simple one. Jack Bogle, who invented the index fund and spent decades fighting Wall Street to make it available to regular people, said it best. Don't look for the needle in the haystack, just buy the haystack. Once you understand that, you can't unsee it. So there you go. Stocks are ownership in real companies. Start with one fractional share this week. Bonds protect short-term money but lose value when rates rise. Know your time horizon. And ETFs, specifically low-cost index ETFs, are the single most powerful tool most people never use because nobody explained it clearly. A janitor in Vermont figured this out on his own and died with $8 million. Now you know it too. If this helped, share it with someone who needs to hear it and subscribe. I've got something just as good coming next week.